The last 5 years before retirement are some of the most critical years in your career. Your 401k is about to stop being just a savings account and it's going to soon become your paycheck. And how you handle that shift can make a big difference in how ready you feel to actually retire. This is a time when we see people come to us with a sense of urgency. They want to get it right, they want to avoid costly mistakes, and they want to feel confident that they're doing everything that they can. But here's the thing. They also know that there are blind spots. This episode is about helping you find them and fix them, because what you do now determines whether you'll retire confidently or if you'll be one of the many people who wish they made better choices before stepping away from work. Welcome back to Ownership. I'm Nick Sapienza. I'm a financial planner at Ritholtz Wealth, and this show is all about helping you take control of your financial future with clarity and confidence. In this episode, I'm going to share with you 8 of the most common 401k mistakes we see and what you should do instead. But here's the catch. Not every move is right or wrong for every person, and we don't make decisions in a vacuum. So instead of simply just calling them mistakes outright, I'll show you when it's a good idea and when it's better to skip. Let's dive in. Number 1, enhanced catch-up contributions. Now, I'm not talking about the typical catch-up contribution that you get to make once you turn 50 years old, which is $7,500. If you're between the ages of 60 and 63, you can put an extra $11,250 on top of your usual 401k limit. So that's on top of the $23,500 limit for employee contributions, and that's before any employer match. This comes from the Secure Act 2.0, but there's another wrinkle. Starting in 2026, if you earn over $145,000, these catch-up contributions will have to go into a Roth account or a Roth 401k. Today it's optional, but next year it's going to be mandatory. So in total, you could be saving over $34,000 per year into your 401k before your employer match. But that's just the beginning. The actual total you can put in your 401k is over $70,000, but we'll get there in a second. First, let's talk about when this is a good idea and when it might be better for you to skip. This is a great idea when you're using it as a tax strategy. So maybe you're in a high tax bracket now and you want to lower your taxable income. Maybe you're coordinating with other income like bonuses or RSUs and you want to offset a higher than normal tax year. Maybe you're managing around Medicare surcharges or ACA phase-out limits, and any reduction that you can get in income this year is going to help. Or maybe, like many people, you expect to have a tax window in retirement where you'll be in a lower tax bracket than you are today. In that case, it's better to defer taxes now and pay the taxes later when you're at that lower tax rate. It's also an opportunity for you to do things like Roth conversions. Number 2, you're accelerating your retirement savings. So you're already making the standard catch-up contribution and you're just going to add the extra $3,750 this year to meet the full match for that enhanced catch-up contribution. Or maybe you're behind on savings and you want to stash away as much as possible before retirement and you have a high income as well. This is a great way for you to fully fund your 401k while tax sheltering as much money as possible. And number 3, you're already well positioned. You already have tax diversification. In other words, you have multiple types of accounts that you can pull from in retirement. So you have Roth IRAs that you'll pull from at a 0% tax. Or you have a regular taxable brokerage account where any withdrawals that you took would incur 15% in capital gains tax at most. Now let's shift gears and talk about when you might want to skip. Number 1, you're creating a bigger future tax problem. Let's say that you've already saved heavily into pre-tax accounts. So most or all of your money are in things like 401ks, 403bs, traditional IRAs, and so on. And you're going to face higher taxes later or larger RMDs or a combination of both. It may be better for you to place that money elsewhere. Or number 2, you need liquidity or more flexibility now. Maybe you lack that tax diversification. Or more importantly, maybe your effective tax rate this year is lower than it has been in the past. Maybe the effective tax rate for you is somewhere around 15%. And so this is a better idea for you rather than to put it into the pre-tax account and pay maybe roughly the same or possibly even more taxes down the road, that you put it into something like a Roth IRA or a taxable brokerage account. That way you have more flexibility with taxable and after-tax investments when you're in retirement, more places that you can pull withdrawals from. Or number 3, you have higher priority saving strategies. Maybe you're prioritizing a mega backdoor Roth conversion over pre-tax savings. Remember, the catch-up can also go into your Roth this year. That is an option for you. So you can make it there rather than in the pre-tax 401k. So all in all, let's say that we have $23,500 that we can max out for our employee contribution. Maybe our employer contribution is somewhere around $8,000. And then we have $11,250 that we can use for our enhanced catch-up contribution. That's $42,750 per year. If you do that for that 4-year period where you're between the ages of 60 and 63, that totals $171,000 that you can sock away into your pre-tax 401k. But remember, that's not the end of it. We'll get more into that in the next section. Number 2, not making mega backdoor Roth contributions. The 401k maximum limit for 2025 is actually $70,000. If you are age 50 or older, that's $77,500. And if you're between the ages of 60 and 63, it's actually $81,250. Remember, in the last one, we talked about your pre-tax plus your catch-up and plus your match, which we estimate to be around $8,000, equals $42,750. Yet the maximum amounts that I just gave you were $70,000 or $77,500, or if you're between the ages of 60 and 63, $81,250. So let's assume that you're between the ages of 60 and 63. You've put in $42,750 between you and your employer so far. You have $38,500 left over. Where does it go? It would go into what's called an after-tax account or a post-86 account. And then from there, you would take an extra step to convert those funds to your Roth IRA. This is called the Mega Backdoor Roth, and it's a way to fund your Roth above and beyond the $7,000 or $8,000 limits. And here's how it works. If your 401k plan allows for after-tax contributions and in-plan Roth conversions, you can contribute all of that extra money to your after-tax account and then convert those funds into your Roth IRA. But of course, there are a few things to know before. First, make sure that your plan actually has an after-tax account. Some don't. Make sure that you can make Roth conversions within that plan and know how frequently you can make them. Is it unlimited so that you can make these conversions every time a deposit hits your account? Is it once a year or twice a year? How often is that window opened? Number 3, make sure that you leave this money in cash. Now, it's not the end of the world. If you have any gains in that account, you can roll over that gains portion to a traditional IRA, or you can pay taxes and continue to convert that money to a Roth IRA. But typically, we don't want to have the extra step. If we're going to make these conversions pretty quickly, we're going to leave it in cash and convert that to our Roth IRA. Now, this is a really good idea when you want more tax-free growth and you make too much money for a standard Roth IRA contribution. But you want to build up that Roth account so that you can have that tax diversification and flexibility in retirement. Number 2, this gives you the ability to avoid what's called the pro rata rule. A backdoor Roth, let's say that you make above the limit to make a direct contribution to a Roth IRA. Well, you know that you have to do a backdoor Roth contribution, but doing so could trigger the aggregation rule or the pro rata rule if you have an existing balance in a traditional IRA. But if your 401k allows for in-service Roth conversions, that will let you sidestep that tax hit and the frustration of the pro rata rule where a portion of that backdoor Roth IRA conversion would be subject to tax. Now let's talk about when to skip. You should skip this if you need more pre-tax savings. Let's say that you're in the 32 or 35 or 37% marginal tax bracket. Let's say that your compensation is in the high 6 figures. It would be much more impactful if you put that money to your pre-tax 401k and then funded your Roth down the road when you retired, when you were in a lower tax bracket at a much lower tax rate. So for example, you have a solo 401k and a high income, so you prefer pre-tax savings to lower your taxable income, or in other words, you'll be at a lower tax rate in the future. So you're delaying taxes until you retire to pay them at a lower rate versus the substantially higher rate that you're at today. Now remember, if you are self-employed, your employer contribution is going to be capped at 20% of your net income. So at about $250,000, you can still hit that $70,000 limit. And if you're age 50 or above, those catch-up contributions are in addition to those limits. Scenario number 2 is if you're really close to retirement and you need to build a cash buffer to cover expenses for the first year or 2 that you are retired. Number 3 is if your plan doesn't allow it. Maybe your 401k doesn't permit the after-tax account and in-service Roth rollovers. In that case, your better option is to do the backdoor Roth contributions. And remember, ideally, you're immediately converting those after-tax dollars to a Roth IRA. Otherwise, if you have any growth while it's in the after-tax account, you have to roll that portion over to a traditional IRA or pay taxes on the gains. It's not the end of the world, but it does add an extra step. Now let's move on to mistake number 3. Mistake number 3 is missing out on the age of 55 rule. Here's a costly mistake that catches a lot of retirees off guard. If you're planning to retire early between the ages of 55 and 59 and a half, you can tap into your 401k without paying the 10% early withdrawal penalty, but only if you keep the money in your employer's plan. If you are retiring between 55 and 59 and a half, and you think you'll need to make withdrawals during that period, it's better for you to wait to roll over your 401k. Leave at least some money in your 401k to preserve that penalty-free access for when you need it. This is called the age of 55 rule, and it's a lifeline for people who need to bridge the gap until they turn 59 and a half. The catch is that it only works if you separate from service at age 55 or later, and you leave your money in that specific employer's retirement plan. Money from previous employers or existing IRAs doesn't qualify. And if you roll those funds into an IRA, You still have another option such as a 72T distribution, but that's usually an area of last resort. So the smart middle ground is to do a partial rollover. Keep enough in the 401k to cover expenses for the next few years and roll the rest to an IRA if having better investment options are really important to you. So of course, this makes the most sense if you're retiring early and you need access to the funds, or if you're in between jobs and maybe it could take a while to find new employment. Maintain that 401k so that you can access it and not have to worry about a 10% penalty. But when it's not, is of course when you're working past 55, or if you have other sources that you can pull from, such as regular brokerage accounts. But one thing to be aware of if you are tapping to the age of 55 rule is that each withdrawal may require a form, and that form may require notarization. Be aware of any potential administrative burden and plan your withdrawals accordingly. Now let's move on to another topic where timing and logistics are crucial. Mistake number 4 is not using the net unrealized appreciation or NUA strategy. If you hold company stock in your 401k, you can move it to a taxable brokerage account or a regular investment account. In doing so, you pay regular tax on the original cost or the money that you put into the stock, and you pay lower capital gains tax on the growth of that stock whenever you go to sell it. Let's walk through the math of this to see when it makes sense. Let's say that, for example, you invested $100,000 into your company stock. That stock is now worth $400,000. You leave the company. Without an NUA, that $400,000 would roll over to your traditional IRA and it would be taxed as ordinary income as it came out. Let's assume that's around 22% capital gains tax. And just to keep it simple, we're not going to assume any growth or staging withdrawals over certain periods of time. Let's say that over time you took all that $400,000 out at ordinary income tax, and that effective tax rate for you was 22%. That's $88,000 in taxes. With an NUA strategy, you would take the $100,000 this year, let's say, taxed as ordinary income. Let's just say that this year you're in the 24% marginal tax bracket, and all of this money would be taxed effectively at 24%. That's $24,000 in taxes. Now, the $300,000 gains portion is taxed at capital gains immediately or when you go to sell. So let's say that you sold it all of this year. That would be about $45,000 in taxes on top of the $24,000 that you paid in taxes on the cost basis. So the total taxes are $69,000, which is roughly 17% of the total amount, versus having all of it at 22% or $88,000. In other words, in this very simple example, you would be saving $19,000 in taxes. But of course, there's a catch. You have to do this exactly right. So let's get into 4 of the NUA nuances and timing rules. Number 1, you must take a lump sum distribution to qualify. To get NUA treatment, you must distribute the entire vested balance from all qualified plans with that employer, 401k, profit sharing, etc., and it must be done in one tax year. No, you can't split tax years like you might normally do for other large withdrawals or large tax years to offset or reduce the tax bill this year. Number 2, ordinary income tax from realizing that cost basis this year will increase your adjusted gross income. So that may affect things like Medicare IRMA surcharges or Roth IRA eligibility or phase outs on deductions, or it could even bump your capital gains rate from 15 to 20%. But there is a silver lining and some savvy tax planning to be done here. You can coordinate your NUA with other tax strategies, such as offsetting it with losses or charitable giving by funding the donor advised fund with the gains portion of the stock that you're transferring over this year. Number 3, capital gains treatment on NUA is immediate. This is a great thing. Once the company stock is distributed in kind to a taxable account, the net unrealized appreciation, or the gain, is immediately eligible for long-term capital gains treatment. In other words, a lower tax rate. Maybe that's 15% or maybe that's 20% depending on your current tax bracket. And lastly, number 4, this is one to watch out for. Additional gains post-distribution will be taxed at short or long-term capital gains depending on the holding period. So any gains after the stock is distributed will follow normal capital gains rules. In other words, the capital gains clock starts anew for the additional gains on top of the portion that was distributed. So after that distribution date. So for example, you transfer the stock valued at $400,000. You hold it and it grows to $420,000. That extra $20,000 gain is subject to its own capital gains timing. So if you sold that $20,000 portion in less than 12 months, you are subject to ordinary income tax. Whereas if you waited longer than 12 months, you would be qualified for long-term capital gains treatment at the capital gains rate of 15 or 20%. So only the NUA portion gets immediate long-term capital gains treatment. Everything else depends on how long you hold it after the distribution. So let's talk about when this is a great idea, when this makes the most sense. When the stock has grown a lot from when you got it, ideally you have substantial capital gains and a relatively low cost basis so that it doesn't affect your AGI too much. You can pay taxes on that original cost now. You can afford to do so. You meet all the IRS rules for timing and lump sum distribution, and it's in line with your overall tax strategy. On the other hand, when it doesn't, is if the stock hasn't grown too much. There's no benefit in you doing an NUA transaction if the stock just doesn't have enough capital gains, or maybe you have substantial cost basis and it would severely affect your taxable income this year. And that cost basis could bump you up to a much higher tax bracket, for example. So let's say that you make $200,000 this year and you have $500,000 in cost basis with very little gain. This would probably be the worst decision that you could make. You're much better off just rolling it all over into your traditional IRA. Now let's move on to mistake number 5. Number 5 is making wholesale changes, big changes to your portfolio in the final years before you retire. Here's a mistake that I see people make all the time. We get close to retirement, the stakes are rising, the pressure builds, and we get anxious. We might think we don't have enough and we need to catch up, and getting more aggressive with our portfolio is the answer. But this really isn't about the portfolio. Most of the time, the real worry is, am I on track and am I going to be okay? And when we don't know the answer, when we don't have clarity, when we don't have context, we think that simply making more money will solve the problem. So we take on more risk, we push for more growth, and we hope that it works out. But real financial planning does the opposite. It ties everything together, your goals, your income, your investments, taxes, into one big picture. And from that big picture, you have clarity and you can make smarter decisions. And you know the material impact that it's going to have on your personal situation and your financial plan. And yes, this is your final acceleration before retirement, but don't mistake this urgency as a need to make changes to your investments. This isn't the time to get more aggressive with your portfolio. It's time to get more aggressive with your savings rate, your planning, your tax strategy. It's time to get more intentional about your financial plan. And moving on to number 6. Number 6, rolling over your 401k if you're working past RMD age. Now, on the other end of the spectrum from people that retire early are people that never retire. If you plan to continue working past age 73, you can delay your required minimum distributions, or RMDs, but if you roll that money to an IRA, you lose that option and you have to start taking distributions whether you want to or not. Let me explain what's happening here. Once you turn 73, the government makes you start taking required minimum distributions from your pre-tax retirement accounts. It's their way of finally collecting taxes on money that's been growing tax-free for decades. So keeping the money in your 401k can be a huge advantage if you're in a high tax bracket and you want to control when you pay those taxes. The problem is many people roll over funds from their 401k or do in-service distributions to an IRA without thinking about this. Once you do that, you're stuck taking RMDs at 73 no matter what. This can have a lot of knock-on effects, like pushing you into higher tax brackets or even triggering much higher Medicare premiums. So before you move any money around, think about your whole situation. Are you still working? What tax bracket are you in? Do you have Roth money that could benefit from different treatment? But don't just consolidate accounts because of ease and access. Make moves that actually help your tax situation. And the bigger picture here is retirement planning is almost tax planning in disguise. So make sure that your plan is by design, not by default. The best moves are the ones that you make years before you're forced to make any decisions at all. Now let's move on to number 7, not using the auto increase feature. One of the simplest, most powerful tools to get an extra few $100,000 into your 401k potentially is the auto increase feature, and most people never turn it on or really even know that it's there. Auto increase automatically raises your contribution rate each year, usually by 1%. It's painless, it keeps your savings growing in line with your income, and over time this can mean a huge difference. So let's take a look at this chart that shows the impact of using the 401k automatic increase feature over time. We have 3 people and all of the numbers are exactly the same for them across the board. We have Nick that starts contributing 5% and stays contributing 5% forever. He's a static 5% contributor. Then we have Sam that uses the auto increase feature. He starts off at 5% and he stops increasing once he reaches 10%. And then we have Sally that starts off at the same 5% and increases all the way until 15% before she stops. Now let's look at the end result. Nick, with his static 5% withdrawal, saved a total of $237,000. Sam, on the other hand, used the auto increase feature, every year increasing by 1% until he reached 10%, and his amount grew to $459,000. And Sally increased all the way to 15%, and her ending balance grew all the way to $559,000, more than double the amount of Nick's. And that's the power of slow and steady increases over time. So in this situation, you don't want to be a Nick. You want to be a Sally. You want to increase as much as you can for as long as you can and let compounding work in your favor again. So here's what you should do. Turn on the auto increase feature, set it to bump your contribution rate by 1% each year until you hit 15% or even 20% if you can. It's one of the few set it and forget it strategies that actually works. Now let's move on to our last and final mistake. Number 8, not taking advantage of a tax window. After you retire, but before age 73 or 75, if you were born from 1960 on, you may have low income years. And this could be a great time for you to move money from your pre-tax accounts to your Roth IRA. When you make these Roth conversions, one of two things will happen. Either you'll use it for future spending and you'll have a bit of a tax arbitrage so that you effectively pay lower taxes, keep more of your gains tax-free, or it will end up being a great inheritance vehicle. And I don't say that tongue in cheek. Many people are receiving an inheritance in their highest income years. That means more and more of your money will be sent to the IRS rather than kept in the family. In both of these scenarios, ideally, you're having more of your gains tax-free and you're paying less to the IRS. You're keeping more of that money in your family and across generations. Now, when this is a great idea is if you have a lower tax rate. You're between retirement and your RMD period. Maybe you want to reduce the size of your RMDs. Maybe that's like a tax time bomb. And by doing this now, you can make a serious dent in your potential taxable impact by making these conversions today at a lower tax rate than what the tax rate might be whenever you begin taking those RMDs. Or maybe you expect tax rates to rise because of RMDs or something else, and you need that tax diversification, and you just want more flexibility down the road in retirement so that you have more tax-free income. Now, on the other hand, it might not make sense. You might want to skip this part if you're trying to qualify for ACA tax credits or avoid IRMA surcharges. Or maybe you have ample tax diversification, you're adequately hedged for any potential tax increases. Maybe it still makes sense to have even less of a burden with the RMDs and still do Roth conversions, but that should be something that's up to you and your tax professional. Luckily for us here at Ritholtz, our CPAs are in-house, and so we work with our clients one-on-one to develop a tax strategy and incorporate that into every financial plan. These aren't just tips. These are decisions that could save or cost you hundreds of thousands of dollars in retirement. And yet, every move depends on your personal situation. And that's what ownership really means. Not just building wealth, but making the most of it by being prepared, knowing what you can control, and making decisions when it matters most. So if you're within 5 years of retirement and any of this hit home, let us know. Throw your questions in the comments or reach out to us at ritholtzwealth.com if you want to work with us. Hit like, subscribe to the ownership channel, and drop a comment with a retirement topic that you want covered next. I'm Nick Sapienza. Thanks for watching. This is Ownership by Ritholtz.